CommitToWealth.com, creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas, bringing you yet another awesome guest. Today's guest, his name is George Arau, and George is the Vice President of Loan Originations at Basis Investment Group, where he deals with a lot of borrowers. He's able to originate, loans and provide both equity and debt. So with that said, George, welcome to the show.
Hey, Juan, it's great to be here. Definitely in these times, it's great to have Zoom and appreciate you giving me the time to be on the show and talk, especially what's going on in the market today. So I'm great to be here.
For sure. And as you said, we definitely want to talk about that. There's a lot of things that I want to cover. Market information, market insight from today, from today's market. So definitely has shifted a little bit. It definitely has changed. So we want to talk about that. But before we get there, let's talk about you. Let's talk about your background. How you got started in the business. My understanding is that you're there in New York. So tell us a little bit more about that as well, and how you got there. Just tell us your background.
Yeah, no, absolutely. Yeah, so I've been in the business for over 20 years, and that being the lending business. Actually, before doing that, I started out in a family-owned business on the restaurant side of the business. We had a pizzeria. Did that for a while. I actually had a couple of businesses, worked for my father, and that's where I kind of learned, the business side. My father was an accountant by trade, so got to learn a lot about the numbers, and then pretty much hands-on business operation. So I've always enjoyed that and always thought, I would do something going forward in my career where it would be on the business side. I worked and working in a restaurant. I'm sure people that do that, there's a lot of hours. There was not a lot of playtime per se, but that's where I got to get my business acumen. And from there, I decided, hey, let me go on to school because I pretty much made up my mind. I wanted to be in the finance industry. And actually, at that time, I was living in California. I'm kind of bi-coastal, so I lived in California for half my life and half my life in New York. So I always had the goal to work on Wall Street, per se. So went to school, went to community college at first, just to get my sort of electives in order, and then ended up got into NYU, where I went to New York University Stern School of Business and got my finance and statistics degree. And while I was there, I took some real estate courses in real estate finance, and that kind of like spearheaded everything. Once I took those classes, I guess that's where it all clicked, and for me, pretty much that's what I want to do for the rest of my career. So, graduated there and got my first job working at Prudential Insurance Company, where we were doing lending for our own corporate book. But at the end of the day, it just spearheaded my career, and from there, I went on to other jobs with all sort of Wall Street oriented and giving me the perspective for the debt side, whether I did lending, whether I did investment management, and funds, debt funds. I even worked at Moody's and structured finance. So at the end of the day, it gave me a well-rounded perspective of the debt markets and equity markets as well, which, like I said, been doing that for over 20 years on Wall Street, and currently at my new position at Basis, sort of stay close to home and doing lending, which I do again. So Basis Investment Group is also, for lack of a better word, it's a financial small private equity firm that originate loans, debt. So we have a fund that we've raised through institutional clients, where we put out money in terms of loan perspective, and we do that on bridge lending, pref and mezz. So that kind of joins the debt and equity side of the business. And then we also have a CMBS program where we do our long-term sort of debt through the CMBS market. And we also do agency, multifamily. And that's kind of like where we got to know each other. And there we do the Freddie SBL program as well as conventional. So currently, we're trying at Basis, we do a one-stop shop approach to lending and trying to, engage clients and keep them sort of, in the relationship by being able to offer a lot of different products. So that's kind of my background in a nutshell. And, I'll just say I've always been in real estate, love the transaction side of the business, and getting to, obviously work hands-on with owners and helping them through the process, be sort of their financial team. So that's kind of the way I would put it. Okay,
great. So definitely does sound like you have a lot of experience and just in the capital markets space, right, industry. So I guess we can start off, by kind of going through these different types of sources. You mentioned, CMBS, you mentioned agency, debt funds. So let's kind of go through each one of those and let's talk about general terms, what to expect, what they look for specifically, and then how the current environment has affected each and every one of them, right? So we can kind of take it from that approach. So we can start off with CMBS, right? I know there's, that's not maybe the most common type of structure that you do. I would imagine, and correct me if I'm wrong, I would imagine that most of them are probably in the debt fund / agency category or categories. But let's kind of get the CMBS out of the way, and we'll discuss that real quick, and then we'll go to the other ones as well.
Yeah, no, sure, absolutely. So the CMBS market, basically the commercial mortgage-backed securities market, it's actually making long-term debt, typically 5 and 10-year money on all commercial property types. Your major food groups, industrial, office, retail, multifamily, and some of the other special assets. And basically that's a structured finance securitization market where we make the loans as a seller servicer, and once we place those loans, it's sold off in a pool to bondholders. So that's kind of how the CMBS market functions. And the CMBS market is priced, it's a spread price product. So we price off of swaps, swaps plus a spread. That market traditionally, when it was called in the CMBS 1.0 era, and that's when the market really boomed, and it was meant to be sort of a liquidity for all markets, and became very prevalent in the secondary and even tertiary markets prior to the 2007 bust or recession that we had, and there was a lot of business to be done in that market. Since then, CBS 2.0 came out, and this kind of sort of changed the ball game a little bit. That market's still in the billions in origination, but it's kind of changed the players. And so for us at Basis, we're sort of like a middle market player, meaning that we focus on loans between really 5 and I would say 50 million, with a sweet spot somewhere in between. And it's a national program, so the footprint is across the U.S. Since the swaps market, or since rates have come down so much, it was an attractive market to do lending for all product types. Maybe not so much multifamily, because the agencies sort of dominate that space. But that being said, it's a good outlet for owners and do refinance and acquisition. And our pricing prior to this most recent, unprecedented phenomenon we're having, it was typically somewhere in the low 4% money. But that being said, the way that the CMBS market functions is that you really, since you're selling bonds, you get guidance for where you need to be priced based on where you sell your bonds. And given what's happening in the market with such volatility and concerns about where are we going, where's the real estate market going, especially different property types and so forth, that's kind of a blown up pricing. So at this point in time, the CMBS market is pretty much shut down just because of the fact that volatility, lenders just don't know how to price. And certainly we're all trying to figure out where that, things are going. So that's the CMBS market, on a quick high level summary.
So in other words, just to summarize, the CMBS market, they're not necessarily a player in today's market, right? Right now, as we're recording this, they've kind of pulled back a little bit, and so they're not really going to be one that you're going to be using for the time being, right? Is that
Correct.
fair to say? Like overall, okay, got it.
Yeah, correct.
Mm-hmm. Okay, great. So that's a CMBS. Quick overview on the CMBS. Obviously, there's bonds that that have to be sold, and that definitely affects the pricing there. But let's kind of get into the other side of it, which is the debt fund and the agency side, right? So those are the two ones that we talk about the most, that we will be most likely using, that are still in business today, that are still out there, lending on different products, and although the terms have changed, they're still very good terms, right? The terms have changed, over the last few days, over the last week or two. But definitely, the spreads have gone up. I know that for sure, especially on the agency side. But
Right.
Despite that, I mean, we're still in a great lending environment, just because of from the interest rate standpoint, right? So let's talk about the debt fund first. And tell us what that is first of all, right? So people can understand what that means. When you hear that, you also hear of bridge. Tell us what those terms kind of mean, and tell us some of the actual loan terms that you can get from those, and how aggressive they are being in today's environment.
Sure. No, absolutely. So that's a good place to start. So basically, within our fund side of the business, like I mentioned, we raised capital where we raised for institutional clients. We actually raised about $410 million, and typically what debt funds do is they would leverage that equity to go out to put to make loans. So meaning that our capacity is really almost double that to $800 million, because we can go and finance ourselves to make those loans. And the reason why I'm saying that is because it has sort of a same perspective as analogy to the CMBS side of this, because you're still getting cost of capital, right, from the backside that kind of determines where pricing is. So with that being said, we're basically, it's a transitional fund for bridge loans, and bridge loans is meant to be used for properties that are going from point A to point B. So whether you're in a scenario where there's you find an opportunity where the property's mismanaged, it's not performing to where current market standards or occupancy is. There's a play on it, whether it's operational or whether there's you're going to transition to another use. So typically, people look for the bridge lenders to bring them some short-term capital between 1 and 3 years, and most bridge loans are 3 years in any case, because there's a time frame for you to get your ducks in a row to do that business plan. So it's a 3-year product with 2 1-year extension options to kind of extend it to 5 years, and those products are priced off of Libor, Libor plus a spread. So they're interest-only loans, and prior to this, again, this unprecedented time, our pricing was somewhere Libor plus 300. Now, obviously, Libor at that time was that index was around 1.3. Now Libor has dipped because the Fed has, basically reduced rates. The pricing is generally not that bad. It's actually pretty attractive for transitional, right? And today we're being, just like every lender, I'm sure, is being more cautious, because you're looking at a pro forma, you're looking at a business plan that's going to get you from point A to point B. So you have to understand where the market's going. So there's going to be, more scrutiny on business plans, sponsors, their background, have they done this before, track record, and the typical terms are, one typical, like everyone else, 1 point origination fee, 1 point exit fee if we do not refinance the loan with an exit strategy. Like, for instance, multifamily would refinance with agency debt. So it's 1 point in, 1 point out, and typical leverage go up to 80% loan to cost. And we also would fund the capital expenditures projected for the deal. So whatever your capex is, we'll put that all together to a total project cost, and we will lend based off that at a 80%. We've gone up to 85% as a max loan to cost. But in today's market, I would say that probably be tempered. But at the end of the day, it's a good way to fund short term sort of business plans, and for somebody to get their property to stabilization, wherever the plan is, and then refinance their long-term debt.
Yeah, that's the key. I mean, that's why these debt funds are there. I mean, they're really helpful whenever you need it, right? I think you have to find the right product, the right opportunity for that, right? I think there's a place and a time for it, right? So can you tell us what that Libor means? What does that mean whenever you said Libor? What does that mean exactly?
Yeah, that's just the index, the Libor interbank product, which is it's put out by the desk out in England, Libor. It's a London interbank Libor, but in any case, it's just a short-term index that we use to price our total rate off, just because it's a short-term loan. And that being said, I don't know if anybody really has been up on it, but anyways, Libor is going out of they're phasing that out just because they need to go to a new sort of product as things are sort of progressing in that market. But in any case, it's a short-term index, just like if think of it like a ARM when you get a residential mortgage, right? Adjustable rate mortgage, and it's priced off something. Usually it's the 6-month ARM, or a 3-month product, something that's short-term where you can put in a total cost at the end of the day from a lender's perspective, that plus a spread to get us to a total rate.
Got it. Okay, so just so people can understand it, that's pretty much it's very simple to understand. I mean, they go off of Libor, and then there's obviously a spread there, and then you're going to get your total overall rate. The good thing about the debt funds is that it's okay, the kind of product that you're buying. I mean, it's okay if it's underperforming a little bit. I mean, if you're 80% occupied, you find a good smoking deal. That's kind of when you want to use one of these guys. And then they'll also give you some, or they can, you can potentially get some of the capex in there as well. So you can get up to 80% of the loan, the cost, and then you can get some of your capex rolled into the loan as well. Which is very attractive, right? Because there's less capital to get to come up front, and it can definitely boost your returns, right? So, that is the debt side. Obviously, you got to find the right type of property to be able to match that. I mean, I think you guys will be happy to lend on 70s, 80s, 90s construction. Multifamily. I'm speaking of multifamily here because I know that you guys deal with different asset classes as well, and more on the multifamily here. But so you're gonna look at anything up and down as far as the vintage is concerned, right? Is that correct?
Yeah, right. So I mean, so first of all, what I didn't mention, we have two sides of that bucket. So since we have institutional money, we look at sort of what I would call more institutional type deals, which means a minimum loan balance of $10 million. And so that would, based off our fund criteria, we probably will look at vintages that are, I would say, tip more likely 80 vintage and over. We will look at some vintage that are 70s. That just goes to the fact of obviously wear and tear, right? And so there's going to be a lot more maintenance and to be done on those properties, and so therefore, we kind of like the newer vintage. But that being said, it's not like we would not look at a 70s vintage. It all depends on what the business plan is. You're going to do some significant rehab, then obviously that's the game plan for that type of deal. But we also do look at smaller loan balance, what we call small bridge deals. And we do that through our correspondent lender, where we have a relationship just because, our fund doesn't mandate for smaller deals. But, like most lenders, you want to do the business and you find a good outlet. And the reason why we do that business, we only focus on multifamily, which is fair point to what you're doing in your business. And we'll look at small balance loans from a million up to the 10 million, that sort of gap that we don't do with our fund, but we do it with a correspondent lender. And what's great with that product, pricing might be a little bit more than our typical institutional. At LIBOR plus 300 will probably be more in the LIBOR, and of mid fours, just because they're smaller deals. That's kind of where the market price is more intensive. But what's great about that is since we're agency multifamily lenders, and the reason we're doing that because we want to bridge the gap to agency, and we're finding a lot more opportunity in that deal size. You get basically two lenders come to the table at the same time, and we size the deal as well, and we'll look at it what the exit strategy is. So that way we bring a sort of one-stop shop approach to that. Borrowers like, hey, you're going to get your agency loan at the end of this, which most people want to do, because it's the most sort of attractive, and we could do that business all over the U.S. We're not confined to one market. It's not just in the Northeast or something to that effect. So I think it's a great product, and we've even looked at deals that might not cash flow, might be a severely distressed, but there's got to be the right business plan and the right sort of track record. But yeah, like you said, you want to take something. You find deals where something's in the 70% occupied or distressed, where hey, this market's at 95%. We could, we know what we're doing. We've done this before. We're just going to be able to capitalize with debt that makes sense and, get those returns you're looking for. So that's kind of the way I see it. Yeah.
So say for example, I find a deal, that is a smoking hot deal. I've never done it before. I mean, this is my first deal that I want to get into the business, and I engage you. Would you still be able to lend to me even if I hadn't done any type of previous transaction like this or previous project like this?
Yeah, right. No, I mean, certainly on the stabilized side of the business, what we could talk about later, as you said, there's ways to approach that. I would say though, most, on the bridge side of the business, it becomes a little bit more, you start kind of more concentrated on having that track record or having, whether it be, one sponsor or two, whichever way you make up your team, somebody that has, shown to do that before, just because from a lender's perspective on the bridge side of the business, there's a lot more things that can go wrong, as you well know, a lot of things that you don't even anticipate happening. And, from a lender's perspective, you want to have a partner that you're working with that has some of that wherewithal. And we're not sort of stuck in a scenario where now we have to come back to the table and, discuss things we don't want to. So we're probably going to be more stringent on having someone that has, or someone a part of the team that has that experience of doing that.
Yes. So I could just simply, find somebody that has done it before and bring them on my team. And then we can, that should be able to bridge that gap, so to speak.
Yeah.
So you guys loan nationwide, like for this product, is it nationwide as well?
Yeah.
So it doesn't matter if it's primary, secondary, tertiary market. I mean, you guys we'll look at that. Just you're more opportunistic than anything else.
I mean, we definitely look at all deals. We've looked at tertiary markets as well. I would just say, we look at the overall picture too, right? Not just the deal. It's got to be the local market, the metrics there and so forth. I mean, I would say, common sense wise, like if you were looking at a deal, you're not going to go to a tertiary market where there's no demand and, you're throwing your money good after bad. So we've done deals in tertiary markets for sure. But it's got to, have the good business plan and the metrics that make sense for us to exit the deal.
Correct. So how has the COVID-19 situation affected these debt funds and their willingness to lend? How have their terms changed
Sure.
from pre and post or pre and now, because it's going on right now?
Right.
Tell us some of the differences that have gone on since this outbreak.
Yeah, no, absolutely. I mean, I would say it's it's pretty much going to be across the board. I mean, even in prior downturns, what happens typically on the lending side of businesses is you kind of like look at your underwriting metric parameters and you become a little bit more cautious. So you would tail back things. So it's the same thing in this market. we might look at deals where we have to see more debt yield, right? Or you would have to see more cash flow. From a DSCR perspective, we're gonna not be so apt to do higher leverage. So those two real quick metrics there. There might be some little between in the weeds stuff, but I would just say from a larger perspective, the cash flow and how that underwrites the DSCR, and then leverage. And then obviously we're gonna be more selective with deals too. I mean, that's just a phenomenon of the whole market, right? Some of those deals that are maybe on the fringes, you might not want to do because you want to look at opportunities that that's more of a lender's market opportunity. But then pricing is definitely has gone up, and I think that's across the board, whether it's bridge or anything else. So I would say those three metrics as predominantly what has changed since before this crisis.
Right. And so how long, I mean, and this is kind of a question that you may not have the answer to because we don't know, right? But how long do you see this happening for? Like, how long do you anticipate this? Or is there a time where these guys are going to be, a little bit more aggressive, in the next, 3 months or so, or 6 months?
Right. No, definitely. I mean, we have the thing about the bridge side or the businesses where we have flexible money and we're flexible lenders. So, we're definitely going to take a quick look immediately, because at the end of the day, it's pro forma business, right? When you're doing bridge lending, because you're taking, like I said, property from A to B. So we're going to be looking at the immediate metrics. Let's take a look at the next month or two in terms of what's happening and digest it. So at this point in time, we kind of took a little bit of step back for a couple of weeks, just because it's so much volatility. I mean, things are happening every minute. Whether the government's coming out with these kind of Feds doing this, all those things that affect this side of the business in terms of rates and mortgage credit. So, right now, I think we're just trying to, survey the land, give it like a couple of weeks. So that way we understand where pricing is too, because, we don't know where the price point is either. I mean, we're still quoting deals, but it's going to be on the higher end. And the same thing with borrowers. They don't know too. Everyone's kind of taking a little step back, but I would say that, within, the next couple of weeks, hopefully we'll know more, and, get back to business as usual, but be a little bit more cautious on deals. Correct.
Yeah. And I can definitely see that. So tell us a little bit more about the agency side. Just give us a brief overview of the agency side of the business that you do. And then also tell us how things have changed over the last couple of weeks. As I said, earlier with the debt funds, how have things impacted the agencies as well?
Yeah, no, absolutely. So, I mean, agency side of the business, I think it's a great part of the business, national, of course, again, in terms of footprint. I'm sure everyone knows that the agency side of the business has, one of the more attractive terms. You can get up to 80% LTV. The debt service coverage is matrix between 1.2 to 1.3, depending on what we call, large, medium, and small market, basically. Rates, prior to this, rates had come down to historic lows as treasuries went down. I mean, we were doing deals at 3.5% rate, even lower. Depends on what market. But that being said, of course, just like everything else, that market's gotten impacted too. And so what we have seen in the last, couple of weeks is rates have come back up, pretty significantly, probably about 80 basis points from where they were. But at the same time, that's still pretty good, historically low rates. So I'd say pricing is probably back to where it was 6 months ago. But what does that mean? That means, you're still getting low 4%, 4.25% rates at this point in time, right? So net, historically, it's still a pretty attractive rate. So, that market's still fluid. the thing about the agency market that people should understand, it's not a market that's priced just, whatever happens to the treasury rate, that's what happens to rates overall. There's other things that come into play. And one of the things is also in the agency market, there's also a securitization market in the back end where the agencies are pulling loans and they're selling bonds. And obviously the pricing is affected by where those bonds trade. And in today's market, since there's a lot of volatility, that's getting widened out. So that means that's why rates have gone up. So there's still going to be volatility there. Things will still remain to change a little bit, but agency business is here. The mandate for agency has always been, hey, we're going to be a liquid player in the market. So we provide liquidity and we're still there, and that's been maintained. That's why we're here. In these moments specifically, we're here to provide liquidity to the market. What have changed? Yeah, there's going to be some changes with regards to certain metrics. Again, just like I mentioned on the other side of the business, we might see some upticks in maybe 5 basis points of the SCR upticks in top markets. We'll see maybe some leverage constraints, maybe not 80% go to 75, but banks were, commercial banks typically were at that 70-75% leverage anyway. So we're not being uncompetitive with the rest of the market. We just need to tighten things up. As you well know, obviously a lot of this, what's happening in the markets hit the workforce housing, meaning the tenant side of the business a lot, right? Because a lot of those service jobs are getting, cut off. We're basically at a standstill. So, we got to kind of see where that plays out and what happens. I'm sure there's going to, everybody's going to go through pain, but more recently, I would tell you that, the agencies are definitely working to sort of address some of those things. We recently came out with a forbearance plan, just like the rest of the federal market mandated 90-day forbearance, which, for those property owners that obviously getting hit by this coronavirus, and you would have to show that there is definitely that issue there that's sort of giving you issues on the revenue side. You can enter into a 90-day forbearance plan that needs to get paid back over 12 months, but there is that, opportunity there to get some relief. And that's as easy as just calling up, whoever your agency lender was, calling up the asset management side, and they're maintaining to be an easy process. And that's something to help out, for sure in those trying times, because, at the same time, we don't know where this is going to go, but at least that's what's going on at this point.
So what are they going to be asking for specifically, and how can they know? I mean, besides seeing the rent roll, besides seeing collections go down, how will they know that it's directly because of the COVID-19 situation and people, for example, losing their jobs and or cutting back on hours and not able to work and pay the rent? What can we do as operators to be able to show them proof that this is directly because of the COVID-19 situation, and here's the documentation. Here you go. Look at it, review it. Let me know if you'll approve my forbearance that I'm requesting. For the next month or 2 or 3. What do we need to do as operators? What can be helpful there?
Yeah, I mean that we're still getting guidance on that, and that process is fluid. But generally speaking, I mean, the agencies are canvassing markets and getting data as to potentially where could this hit first and foremost, right? And it's going to be a lot of service oriented areas in terms of markets where there's a lot of service jobs or hubs to where, like for instance, airline hubs. Obviously those are getting hit, but the actual process has not come out yet in terms of what exactly they're looking for, other than to say, hey, I'm having issues. Obviously, you're showing paperwork in terms of where your collections are at, right? Or you're having grievances by tenants and sort of documenting that and presenting anything that could be documented to present that case, basically. And I'm sure, things are going to be verified and checked, but I would say at this point in time, that's kind of like the soft guidance we have. There hasn't been a formal process put out there, but the other point is we really have to get in touch with the servicing side of the business. I'm on the origination side. We're getting communications coming down, but really, I would say first and foremost, reach out to your asset, the asset management side of the business, and everyone's getting geared up to be able to respond and help.
Yeah, that's a very good point. So it's better to be proactive and reach out to those guys. Now that even if you don't need it right now. I mean, we don't know how long this thing is going to last, right? If it lasts 6 months and then the last 6 months of the year, we don't know, right?
Right.
Hopefully not, but we don't know. So it's better for you to be proactive and reach out to those guys now. We know when you don't need it, and like that, you have that communication going with those guys. And if you do need it, then you already built that communication over a month or 2 or 3, right?
Right.
One thing that we're doing specifically for our properties is we are adding a line. It's above the line, obviously, but a line that's called specifically as COVID-19, just like that, COVID-19.
Yep. And
so any loss of lease that we have, or any bad debt that we have, or anything that's happening because of direct impact of the COVID-19, we're going to put it on that line, and like that we're able to keep track of it, internally. And then also, if we're able to, if we get to that point where things are getting a little sideways and getting a little scary here, we've already reached out to our lenders, but we'll be able to show them, hey, look, here's our documentation over the last 2 months. This is what happened. Obviously, you see these 2 months here, our collections went down. Here's our bad debt, loss to lease, everything all in one in this line here, and it's because of this. People have lost their jobs. So I think at the very end of the day, it's better to be proactive, try to figure those things out. And we don't all have an answer to it, but we just got to. The more you can do to be proactive, the better. I think at this point, right? This goes in. We focus on commercial real estate, right? This is commercial. You're dealing with lending on large commercial properties. But even if you have a small property, right? And I don't know how many of you listening have a smaller properties under 4 units that would be considered residential. I mean, you could do the same thing for that, right? Do the same thing for that. Keep track of it, and then ask your lender for forbearance if you need it, right? If and when you need it. Obviously, you gotta check what those terms will be. I mean,
Sure.
You're gonna have to pay it back, within a certain period of time. So is that is free money or just getting pushed back altogether? I mean, there's gonna be a payback period, right? Lender by lender, it's gonna be different, but be proactive. Again, be proactive and try to stay on top of that as much as possible.
No, I think that's spot on, and you're right. The communication is key. And that's a good sort of strategy you made about, document that, really clearly, right? This is coronavirus, sort of bad debt, whatever you want to call it. I think that makes total sense. I mean, even on a residential side, there's definitely forbearance, and maybe that might work a little bit different, where they might tack that amount to the back of your loan. But I know that specifically on the Freddie and Fannie side, it's going to be a 12-month payback after that forbearance is ended. And so for sure, reach out, speak to these folks, and clearly get the guidance and documentation, and you have all the information to make the right decision.
Yeah, at the end of the day, we're all going to get through this. I mean, we're going to look back from this these days, and we all learned a lot, right? Because I think people are going through some unprecedented times right now, and I mean, as a country, as a world, it's together. We're going to get through this, and it just, we have to fight through the times, the tough times, right now. But very interesting, how all together, how it can affect lending as well. It's very interesting. But despite all that, we're still in a good, strong lending environment. Just get with your lender. Get with George. I mean, he definitely will be able to help you out on that. So, George, Absolutely. It is time for our Nuggets of Wealth. These are questions that I ask every guest every week, and hopefully they're able to help out the audience. So question number 1 for you is, what is a good tool, source, or platform that you use almost every day in your business or in your personal life that can also help others?
Well, I like to do a lot of, definitely research and reading. And believe it or not, which kind of attunes to what you're doing. Is I like doing looking at a lot of YouTube. There's a lot of good content out there. I really must say, a lot of good content on whatever you want to know, whether it's what we're talking about, or even the coronavirus and sort of how does that affect you and what you should do. Obviously talk to a lot of industry foes and friends out there to learn, but definitely I like to use YouTube and that web content to keep me current. Sometimes even get better sort of information than watching CNBC, which is a different content, right? So that's what I would say.
Yeah, no, that's a very good one. I mean, you're gonna find anything and everything on there, right? You'll learn a lot. I mean, there's everything on there. So I use it as well. I will say that I don't use it as much as I should because there's so much good information out there. But I definitely need to get on that for sure. So that's a good one. Thanks for sharing that one. So what is the top advice that you would give to potential borrowers in today's market, right? In the current situation that we're in, what's the top advice you would give to them?
So yeah, I mean, now than ever, right? Understanding, your market research, keeping on top of current situations within, whether it be the capital markets or not. Dig down on your underwriting, be realistic. I would say more than ever, and take into account from the borrower to lender's perspective that those metrics that you were used to underwriting before are going to be tightening up. Because that's definitely going to affect your overall numbers. And I would just say, reach out to your relationships. And if you have direct lender relationships, I mean, that's one of them that I would reach out to as a borrower, just so I can get an understanding of what's happening in the market, just like we're doing here today. And if you have a good relationship, you can actually go through scenarios, right? Whether it be, this is what I'm looking at, or this is, where I have this loan on the books now. What is your thoughts? What do you think, I should be doing or looking at? So I would just say this is a time of sort of communication and keeping in touch. Look, like you said, the reality is we're going to get over this hump for sure. I've been through this once in 2007 and 8. And it certainly was a different crisis because it happened over an 18-month period. Things sort of trickled at a slower pace. Now we're getting hit with an immediate sort of downturn. There's no warning. So, everyone gets frantic and panic, right? But there is a light right at the end of the tunnel. And, just remember from back 07, 08, the markets came back roaring to where we are today. So, things, I'm sure valuations and things will take a hit, right? We don't know how much, but I think you just got to take it, in a short-term intervals to understand what's happening. So that way you're not, planning for something too long ahead, and then you're not understanding what the short term is.
I agree, George. I think, that's also why it's very important to, like you said, communication is always very important, but if you're going to do anything, I think it's also very important to maybe look at the longer term debt, right? I mean, some of the guys that, and I know a brick product, they're good. There's a time and a place for it, and I'm not downplaying it at all. But if your loan is due this year, then you're going to be in a little bit tougher situation versus you have agency debt, then that's typically long term. Then you can kind of ride through the little storm, and then like you said, we're going to get through this, and things are going to get back to normal, if you call this normal, or not this current time, but just a few months ago, normal times, and then values will go back up as well, right? So, but I think there's a time and a place for everything. Just know the risks and the rewards to every single product that's out there. They're only there to help you, right? So you as a borrower need to know what's the best type of situation. The best type of product for your situation, right? And that's what guys like you're there to help, to assist, right? To guide, right? So,
absolutely.
Very, very good. Yeah. So you mentioned some of the things that you some of the advice that you would give to potential borrowers in today's market. What about the flip side? What about some of the mistakes that you've seen borrowers make, right? So maybe you kind of gave them guidance on doing this, and then they kind of went the other way without taking your advice. What's kind of some of the mistakes that people have made in the past that it just kind of stands out for you?
Yeah, well, that's a good question. So, I mean, obviously, every time I meet up and talk to people, the one thing that a lot of people don't take into account is sort of a lender's underwriting versus a borrower's underwriting, and then being able to really, being able to hit your numbers. For instance, underwriting that doesn't make sense sort of in the buckets like, variable, variable expenses where people are not taking into account certain blips that could happen, such as now. I mean, I'm getting a little bit stunned on that, but I would just say, definitely take a lender's point of underwriting and getting that sort of done. I mean, with regards to, just going back to your point, if you're already in a long-term deal, as long as you have tailwind, you have a tail on your debt, I think you should be fine. I mean, what I think that the SBL market started in 2015. If I'm even thinking about those deals that are coming due now, I would suspect that the rates are probably somewhere in the fives or high fives rate anyway. So from that perspective, you're still going to get a better deal today than you were back then. But you just gotta, from bar, you gotta sort of work that cash flow, and hopefully get that cash flow as high as possible with regards to, from the lender side, because you want to get the most, sort of loan proceeds for your buck, and that just basically means working on that cash flow, top line and bottom line.
Correct.
So I don't know if I answered your question.
Yeah, no, I mean, just make sure that you take take the lender's guidance in underwriting, their advice that they give you, take that to heart, right? And really, apply that to your deal, apply that to your underwriting. And if it doesn't make sense, then maybe tweak it a little bit. But because you guys do this for a living, I mean, this is all you guys do. You guys see several different deals. If you see a new guy that's trying to buy a deal, then it's going to be, a lot of times they get, they use feelings over reality and logic.
Right.
So you have to make sure that you take your lender's advice on a lot of the underwriting and the process as well. So very good information, George, there. So George, man, where can our listeners go to contact you and find out a little bit more about you and what you're doing?
Yeah, sure. And you could definitely, you could contact me at you directly contact me at 646-522-1656. That's my direct cell number. I always love to hear from folks and have conversation and help any way I can, whether it be advice or, even making the right connection. You just never know in this business. And my email address is garau@basisinvgroup.com. You can also go to our website, Basis Investment Group, find out a little bit more about our business. But, I'm happy to sort of connect with anybody for sure, and help out, discuss anything that you're going through now, and certainly talk about debt or financing. So, yeah, I welcome the conversations.
Yeah. Well, thank you so much, George. I mean, I appreciate your time. I appreciate the, all these tips and information that you gave us, throughout the lending environment. You're definitely a wealth of knowledge. So, I wish you, to continue success in the business. And, guys, if you have any questions, feel free to reach out to George. I mean, I've reached out to George, several different times myself. We stayed in contact many times. So, if you guys have any information or have any questions and, regarding any kind of deals, just any questions, I'm sure that he'll be able to help you out. Or in addition to that, he will also be able to, just connect with somebody else that can really help you out. So, he's been in the business for a long time and can really help you out. So just make sure that, you keep that in mind, and we'll put your contact information there in the show notes as well. So George, thanks again very much. We really do appreciate your time, and like I said, we'll be in touch.
Yeah, Juan, hey, great. Appreciate you having me on, man, and all the best to you. Stay safe, and I'm sure we'll be talking in the near future.
CommitToWealth.com, creating a legacy by committing to real estate wealth.